China-focused funds have surged over 30% in the last month. Stimulus-driven growth is catching fire, and opportunities seem endless. Major players are pouring money into undervalued Chinese tech stocks, and momentum is building with every passing day. It feels like the kind of rally that comes once in a lifetime. AI companies scaling fast, stimulus checks pouring into key sectors, and every trade promising big returns. Every investor wants in, and every moment on the sidelines feels like watching free money slip through your fingers. If you don't jump in now, will you miss your chance?
But smart investors know. Every boom carries its own risks. This rally isn't built on solid economic fundamentals. It's a response to years of economic slowdown, crushed valuations, and government stimulus aimed at reigniting growth. Real estate debt lingers like a dark cloud, and manufacturing is struggling to find its footing. What we're seeing right now is momentum trading driven by cheap valuations and fast stimulus flows, opportunities that can vanish just as quickly as they appear.
And here's the danger: the shadow of geopolitical risk looms over everything. A sudden conflict between China and Taiwan could pull the rug out from under the market overnight. Remember what happened when Russia invaded Ukraine? In an instant, Russian stocks became worthless, frozen by sanctions, and investors were left holding the bag. That's the kind of risk we need to prepare for today.
Welcome to Finance Frontier AI Make Money. Today's episode is titled, Navigating China's Stimulus Rally, Maximize Gains, Manage Risk. In this episode, we'll show you how to ride China's stimulus-fueled rally while protecting your portfolio from catastrophic risks, like a China-Taiwan conflict.
And today, we're coming to you from the heart of Asia's financial powerhouse, the Singapore Stock Exchange, SGX.
Imagine standing in the Marina Bay Financial District, surrounded by skyscrapers that glitter under the tropical sun. The SGX building is sleek and modern, its glass walls reflecting the surrounding skyline. Across the street, the iconic Marina Bay Sands looms large, like a beacon of ambition, a symbol that wealth and opportunity are always within reach for those bold enough to seize them.
As you step inside the SGX, the hum of trading terminals fills the air. You can hear the soft tapping of keyboards and see digital tickers scrolling stock prices from across the world: Shanghai, New York, Hong Kong, all connected in a delicate dance of markets and opportunity. There's a buzz in the atmosphere, a feeling that fortunes are being made and lost with every tick of the clock.
Singapore isn't just a location. It's a metaphor for what this episode is about. Balancing risk and reward, knowing when to seize opportunity and when to hedge your bets. Just like the traders here, investors need to move fast and adjust their strategies as markets shift.
Right now, China offers exciting opportunities: stimulus-driven AI companies, undervalued consumer stocks, and a fresh wave of optimism. But every opportunity carries risk. Markets can change in an instant, and being unprepared can mean heavy losses.
That's why having a strategy is essential. In this episode, we'll walk you through step-by-step hedging techniques that let you ride the rally without exposing your portfolio to disaster. Whether you're focused on making gains from China's growth or worried about protecting your wealth, this episode has the tools you need.
Stay with us as we break down how to capture gains safely, because when markets are unpredictable, smart investors move with both boldness and caution. In our last episode, we explored the incredible rise of QuantaSing, QSG, a stock that surged more than 189% in just 9 days. This rally wasn't just a flash in the pan, it was a signal that China's stimulus measures are starting to take effect. Investors, sensing an opportunity to get in early, jumped on undervalued stocks in key sectors. QuantaSing became a standout, representing the potential profits that come from targeted government intervention.
What's driving this rally is a combination of stimulus packages, policy easing, and historically low valuations. China has been funneling capital into AI and tech to reignite growth, following years of market underperformance. Consumer-facing tech companies like Alibaba and Tencent are now back in favor, while ETFs like MCHI and KWEB have attracted large inflows. Investors believe the Chinese economy is on the verge of a new cycle of growth, fueled by this combination of government spending and strategic sector support.
At the same time, China's 5-year plan has shifted its focus towards AI development and digital infrastructure, creating opportunities across industries. Analysts are already comparing this to the early 2000s tech boom in the US, suggesting that these sectors could drive substantial returns over the coming years. But with opportunity comes volatility, and this rally is running on momentum more than fundamentals.
Beneath the surface, structural challenges remain. The real estate sector is still struggling under a mountain of debt, and manufacturing output hasn't returned to pre-pandemic levels. Consumer demand is recovering slowly, and there's uncertainty around how long the government will keep stimulus measures in place. These factors make the market vulnerable to sudden shifts, especially if external shocks disrupt the delicate balance.
This is where timing becomes essential. The Chinese market offers incredible opportunities, but it also carries significant risks. QuantaSing's rally shows just how quickly profits can accumulate, but it also highlights how momentum-based gains can disappear just as fast. Investors must be ready to adjust their portfolios swiftly.
That's what today's episode is all about. How to position yourself smartly. You'll learn the strategies needed to capture the upside of China's rally while hedging your portfolio against risks, whether it's policy changes, a real estate collapse, or geopolitical tensions with Taiwan.
With a balanced approach, you don't need to fear these risks. You'll stay invested, enjoy the gains, and sleep soundly knowing you've got the right hedges in place. The key is preparation, acting before the market shifts. Let's move on to our next segment to understand how geopolitical events can derail even the strongest rally and why hedging for tail risks is crucial. When Russia invaded Ukraine in February 2022, global markets were completely blindsided. Overnight, billions of dollars in Russian stocks became worthless. Investors with exposure to Russian energy giants, industrial firms, and financial institutions watched their portfolios crumble as sanctions froze assets and foreign investors were left with no way to sell their holdings. Entire funds were locked out, unable to react in time. It was a devastating reminder that markets don't always give you a chance to exit gracefully.
The Russia-Ukraine crisis was a textbook example of tail risk. These are the types of events that are unlikely but devastating when they occur. The black swans that catch everyone off guard. Even seasoned investors found themselves scrambling, as trading halts and market freezes kicked in before they could act. The Russian market was full of opportunities right up until the invasion. But when war broke out, it didn't matter how good those investments looked on paper. Everything became untouchable.
And this is exactly the kind of risk that China investors need to prepare for today. Tensions between China and Taiwan have been simmering for years, and while no one knows if a conflict will happen, the possibility is very real. Imagine if markets react the same way they did during the Russia-Ukraine conflict. Chinese stocks could nosedive overnight, trading could be halted, and investors could find themselves holding frozen assets. ETFs like MCHI and KWEB could drop 30% in a matter of days, while companies like Alibaba and Tencent would be caught in the crossfire.
The warning here is clear. Hedging for tail risk is non-negotiable. You can't wait for the conflict to erupt or for markets to start crashing. It will be too late by then. Smart investors prepare ahead of time by setting up hedges when the market is calm, even if the risks seem distant. The idea is to have a plan in place before the crisis hits. Hope is not a strategy, you need real protection.
One of the biggest challenges with geopolitical risks is that they strike without warning. There's no clear signal or gradual decline to prepare for. Everything can change overnight. That's why investors who had hedged against Russia either through puts, safe haven assets, or currency hedges were able to protect their portfolios. Those who didn't lost everything.
And that's the key takeaway here. It's not about avoiding risk but managing it smartly. You don't need to sit on the sidelines just because the market feels uncertain. With the right hedging strategies in place, you can stay invested in China's rally without fearing a sudden downturn. Hedging isn't about being pessimistic. It's about staying proactive and staying in control.
The China-Taiwan scenario isn't some distant, abstract risk. Military drills are becoming more frequent, and diplomatic relations between China, the US, and Taiwan remain tense. A sudden escalation could trigger immediate market turmoil, with trading halts and sanctions disrupting portfolios in ways we've already seen during the Russia-Ukraine war. You need to be ready now, not later.
In the next segment, we'll dive into our sweet spot strategy, a detailed portfolio plan that gives you the maximum upside in China's rally, while making sure you're protected against the worst-case scenario. With the right strategy, you can profit confidently no matter what happens next. Let's get started.
Now that we've discussed both the opportunities and risks, let's dive into the sweet spot strategy, a plan that helps you capture China's market upside while hedging against catastrophic risks. This strategy is all about striking the perfect balance between bold growth and cautious protection. The goal is to stay invested without leaving yourself vulnerable to market crashes or geopolitical conflicts.
The strategy begins with 70% of your portfolio allocated to high-growth Chinese stocks. This includes companies like QuantaSing, Alibaba, and Tencent, as well as ETFs such as MCHI and KWEB. These stocks are positioned to benefit the most from China's stimulus measures, focusing on AI development, consumer tech, and digital infrastructure. With this large allocation, you capture the full potential of the current rally, while gaining exposure to key sectors driving long-term growth.
But with great opportunity comes risk, which is why the next part of the strategy focuses on protection. We allocate 10% to SQQQ out of the money, OTM, call options. The SQQQ ETF is an inverse fund that rises 3x as fast as the Nasdaq falls, providing a powerful hedge in case global tech markets experience a downturn. If geopolitical tensions escalate and tech stocks tumble, these call options will skyrocket. Gains of 500% to 1,000% are not uncommon in volatile markets.
We also allocate 5% to OTM puts on MCHI or KWEB ETFs. This serves as a direct hedge against China's market. If the rally collapses due to a policy reversal, geopolitical crisis, or another real estate downturn, these options will gain value rapidly. FAR OTM puts allow us to keep costs low, ensuring we aren't overpaying for protection we might not need, while still providing a safety net if the worst happens.
The next layer of the strategy involves 10% allocated to gold ETFs and U.S. Treasuries. These instruments serve as your safe haven assets. Gold tends to rise during times of uncertainty, offering a reliable store of value, while short-term U.S. Treasuries provide both liquidity and stability. They won't generate massive returns, but they give your portfolio a cushion when volatility spikes.
Finally, we allocate 5% to currency hedges. A call option on the US dollar or a short position against the Chinese yuan ensures you're protected if the yuan weakens during a crisis. Currency risk is often overlooked, but it can have a significant impact, especially during times of geopolitical instability. With this hedge in place, you protect your gains and prevent unexpected losses from currency devaluation.
This multi-layered strategy ensures you stay invested while also managing your downside risk. If the rally continues, your 70% growth allocation delivers strong returns, and your hedges expire at minimal cost. But if a sudden downturn occurs, whether from geopolitical tensions or market volatility, your options and safe haven assets step in to protect your portfolio.
This approach lets you enjoy the upside of the market without leaving yourself exposed to unmanageable risks. You're not sitting on the sidelines paralyzed by fear, and you're not over-leveraging yourself in hopes of a perfect outcome. The sweet spot strategy gives you the best of both worlds. Bold investing with smart protection.
This is what smart investing looks like in a volatile world. You position yourself to profit from the rally while being prepared for the unexpected. The sweet spot strategy ensures you're always in the game, ready to capture gains, but never at the mercy of the market.
In the next segment, we'll test this strategy under real-world conditions. What happens if the rally continues? And what if geopolitical risks materialize? Stay with us as we run through both bull and bear scenarios to see exactly how this strategy performs in practice.
Now that we've laid out the sweet spot strategy, let's walk through two real-world scenarios to see how it performs. First, we'll explore a bullish scenario where China's rally continues on the back of stimulus and market optimism. Then, we'll switch gears to a bearish scenario, imagining a sudden geopolitical shock that sends markets into a tailspin. These scenarios will show you how our strategy holds up in both up and down markets, giving you the tools to invest confidently no matter what happens next.
In the bullish scenario, China's stimulus policies take hold, and sectors like AI, consumer tech, and digital infrastructure surge. Companies like Alibaba, Tencent, and QuantaSing report better than expected earnings, while ETFs like MCHI and KWB attract inflows from institutional investors. Optimism spreads as China's economic growth exceeds forecasts, and markets rally across the board.
With 70% of your portfolio allocated to high-growth Chinese stocks and ETFs, you're perfectly positioned to benefit from this rally. QuantaSing climbs another 50%, while Alibaba and Tencent recover to pre-regulation levels, driving double-digit gains. Your options hedges, such as SQQQ calls and MCHI puts, expire worthless, but that's the best outcome. They cost only a small premium, but they gave you peace of mind throughout the rally.
Meanwhile, your gold ETFs and U.S. Treasuries stay steady, offering stability even in an upmarket. Although these safe haven assets don't generate significant returns in this scenario, their presence is still valuable. They keep your portfolio balanced and protect you if market sentiment shifts unexpectedly. This is the essence of the sweet spot strategy, capturing growth while staying prepared.
Now let's switch gears to the bearish scenario. In this case, tensions between China and Taiwan escalate rapidly. Military drills in the Taiwan Strait turn into a full-blown crisis, and the U.S. imposes sanctions on Chinese companies. Global markets panic, and ETFs like MCHI and KWEB nosedive by 30 to 40% within days. Tech stocks like Alibaba and Tencent lose ground as fear spreads.
Here's where your hedging strategy becomes essential. As Chinese stocks plunge, your MCHI puts gain value, offsetting the losses from your core positions. At the same time, the SQQQ ETF surges 70 to 80%. As tech markets around the world come under pressure, your OTM calls on SQQQ deliver massive gains, ranging from 500% to 1,000%, giving you the cushion you need to stay afloat.
And it doesn't stop there. Gold rises sharply as investors flee to safe haven assets, while your short-term U.S. Treasuries maintain stability, providing liquidity. Thanks to these hedges, your portfolio remains intact, even as others scramble to sell at a loss. This is the power of smart hedging. It keeps you in the game, regardless of market conditions.
The key takeaway is this: hedging isn't just about survival, it's about staying in control. When you have the right safety nets in place, you can participate in the rally with confidence, knowing you won't be caught off guard if the market turns against you. This strategy ensures that even in the face of extreme events, you're not forced into emotional decisions or panic selling.
In both scenarios, whether the market continues to rise or crashes, you are prepared. The sweet spot strategy ensures you capture gains in the good times and stay protected during downturns. It's not about guessing what will happen next, it's about being ready for whatever comes your way.
In the next segment, we'll introduce AI-powered tools that can give you an edge, offering real-time insights into market sentiment and geopolitical developments. These tools help you make adjustments before the rest of the market reacts, giving you the advantage. Stay with us as we explore how AI can transform the way you manage risk and capture opportunity.
In today's world, the market moves fast, and by the time news hits the headlines, it's often too late to react. That's why AI-powered tools have become essential for modern investors. These tools scan millions of data points in real time, from news feeds and government announcements to social media sentiment, giving you a chance to act before the market reacts.
Let's go back to the Russia-Ukraine conflict as an example. While most investors were blindsided, some who used AI-driven sentiment analysis saw the warning signs early. These systems detected changes in the tone of diplomatic statements and shifts in social media conversations long before the invasion occurred. The lesson is clear: those with the right tools can act faster and smarter.
Now imagine applying these same tools to the China-Taiwan situation. AI algorithms can scan diplomatic updates, detect changes in military activity, and monitor public sentiment across Chinese-language media. When tensions start to rise, these tools give you the early alerts needed to adjust your portfolio before markets react.
But AI's value isn't limited to geopolitical risk. It's also a powerful tool for predicting market volatility. By analyzing historical data, AI can identify patterns and predict when the market is likely to experience sudden swings. This is invaluable when you're managing instruments like SQQQ options or OTM puts. If AI signals that volatility is on the rise, you can adjust your hedges in time to lock in better prices and greater protection.
AI tools can also uncover hidden opportunities. Algorithms that scan financial reports and earnings calls can detect subtle shifts in a company's strategy or growing investor interest in a particular sector. These early indicators allow you to enter a position before the broader market catches on, whether it's in AI development, consumer tech, or undervalued sectors.
And perhaps the most powerful aspect of AI is that it helps remove emotion from investing. Many investors panic during downturns or hesitate to act during rallies, losing out on both ends. But AI-driven systems offer objective, data-driven insights that allow you to stick to your strategy and act decisively.
Of course, AI tools are only as effective as the strategy behind them. They provide the data, but it's up to you to interpret the signals and act accordingly. That's why combining AI-powered insights with the sweet spot strategy we outlined earlier is a winning formula. It ensures that you're always positioned to capture growth while managing risks proactively.
The key takeaway here is this: staying ahead of market risks requires more than just following the news. With the right AI tools, you gain insights that let you act before the market reacts. This gives you a critical edge in managing your portfolio and staying one step ahead of geopolitical and market risks.
In the final segment, we'll summarize the key lessons from today's episode and leave you with an actionable plan to invest confidently in China's rally while managing risks effectively. Stay with us, it's time to put everything we've covered into action. So, what have we learned today? At the heart of today's discussion lies a simple truth: successful investing is about balancing opportunity with risk. China's market offers some of the most exciting opportunities in years, driven by stimulus, undervaluation, and AI-driven growth. But we know that opportunities don't come without challenges, and those challenges can appear suddenly and disrupt everything.
The sweet spot strategy we discussed today offers the best of both worlds. Exposure to growth stocks and ETFs like QuantaSing, Alibaba, and MCHI, with smart hedges in place to guard against volatility and geopolitical risk. You don't have to avoid the rally out of fear, nor do you need to dive in headfirst without a safety net. This strategy ensures you profit with confidence.
The lessons from the Russia-Ukraine crisis remind us of the importance of being prepared. When geopolitical events unfold, they don't wait for investors to act. Markets freeze, sanctions take hold, and assets become inaccessible. The same risks exist in the China-Taiwan scenario, making it essential to hedge your bets before the unexpected happens.
With AI-powered tools, you can take your strategy to the next level. These tools offer real-time insights into market sentiment and geopolitical developments, giving you the advantage of acting ahead of the market. Combine these tools with the sweet spot strategy, and you've got a winning formula for navigating uncertainty with precision.
The key takeaway is this: invest boldly, but invest smart. Sitting on the sidelines might feel safe, but it means missing out on incredible opportunities. At the same time, diving in without hedges is a recipe for disaster. The goal is to strike the perfect balance: stay in the market, but stay protected.
Before we go, we'd like to thank you for tuning in to Finance Frontier AI Make Money. If you found value in today's episode, be sure to subscribe to the podcast and leave a review. It helps us reach more listeners and keep bringing you actionable strategies to build your wealth.
And don't forget to follow us on Twitter and social media for real-time market insights and exclusive content. Use the hashtag #FinanceFrontierAI to join the conversation. We'd love to hear how you're applying today's strategies in your own portfolio.
Stay tuned for the next episode, where we'll dive into emerging markets beyond China and uncover the next wave of opportunities shaping the global economy. You won't want to miss it.
Thank you for joining us today. Until next time, remember, in investing, what's comfortable is rarely profitable. Stay bold, stay smart, and keep building your future.
A quick note on the music you heard today. Thanks to Vibe Tracks for the track Crystal, licensed under the YouTube Audio Library license. It's available for use without attribution, and we encourage you to explore it for your own projects.
This episode is copyright 2024 by Finance Frontier AI. All rights reserved. Redistribution or reproduction of this content without written permission is prohibited. See you next time.